Hey there, and welcome back to the deep dive.
Great to be back.
Ever stared at a company's financial report and felt like, I don't know, like you needed a secret decoder ring?
Ah, yeah, I hear that a lot.
Like it's the secret language, right? Spoken only by a select few, packed with terms that just seem designed to confuse.
They can definitely feel that way sometimes.
Well, you've landed in exactly the right place. Today, we're cutting through all that jargon.
We're going to try and make this whole financial puzzle make a bit more sense.
Think of it less as this dense, impenetrable document.
Exactly. Think of it more like a company's story. Yeah, a story told in 3 essential chapters.
Okay, I like that. 3 chapters.
Yeah, you get a snapshot, its health at one specific moment. Then you get a report card on its performance over time.
Right.
And then a really comprehensive view of all the shifts, big and small, and its overall equity. Understanding these isn't just for, like, Wall Street analysts.
No, definitely not.
It's really for anyone who wants to grasp how businesses actually work, how they thrive, or sometimes how they struggle.
Exactly. So let's unpack this financial mystery together. Our mission today, make sure every single piece is easy to understand.
Yep, give you a solid foundation.
So you feel genuinely well-informed by the end of this. 1, setting the stage. The full financial picture, why we need all the pieces. Okay, let's start right at the beginning then. When we talk about general-purpose financial reporting,
Yeah.
what are we actually diving into? Is it just like a big binder full of confusing tables?
Hopefully not as confusing. No, basically under U.S. GAAP, that's generally accepted accounting principles.
Right, the rule book.
Pretty much. General purpose financial reporting means a complete set of financial statements, and crucially, they always come with their notes.
Ah, the notes. I always hear about the notes. Are they important?
Absolutely vital. Think of them as the director's commentary on a DVD. The raw numbers tell you what happened, but the notes provide the context, the explanations, the extra details, the why and the how. They're the narrative behind the data.
So it's more than just numbers. It's the numbers with their story. Got it. And how many of these statements are we usually talking about? I hear about income statements, balance sheets. Is that it?
Good question. Those are the big ones, but that's just the start, really. To get the full, comprehensive picture, companies typically put out 5 key statements.
5. Okay, let's hear.
First, you've got the statement of financial position. Everyone knows that as the balance sheet. That's your snapshot.
The financial selfie, right?
Exactly. Then there's the statement of earnings, or the income statement. That tells the story of performance over a period.
Like the highlight reel.
Yeah. After that, we broaden the view with the statement of comprehensive income. It gives an even wider look at financial performance changes.
Okay, comprehensive sounds important.
It is. Then we have the statement of cash flows. Super important, shows exactly how cash moves in and out. Where did it come from? Where did it go?
Cash is king, after all.
Indeed. And finally, the statement of owner's equity. This one tracks all the changes in what the owners actually own, their stake in the company.
Wow, okay, 5 different lenses. It really sounds like each one answers a different, specific question about the company.
That's precisely it.
So you really can't just look at one and think you know the whole story, can you?
No way. You absolutely need all the pieces. Think of them not as separate documents, but as different perspectives telling one complete, interconnected story.
Like different camera angles on the same event.
Perfect analogy. Each one gives you unique insights. The balance sheet shows what you have and owe right now.
The snapshot.
The income statement tells you how well you did over the last quarter or year.
The performance report.
Exactly. And it's putting them all together that lets users, investors, lenders, maybe even you get that holistic view. It lets you ask the smart questions like, okay, they made a profit, but do they have enough cash to pay their bills next month?
Right, connects the dots.
It's crucial for making informed decisions. 2. Deep dive 1. The balance sheet. A snapshot in time.
All right, let's dive into the first big one, the balance sheet. The financial selfie. A picture of the company's financial standing at one specific moment, like midnight on December 31st.
Exactly. It freezes that moment in time. It doesn't tell you about the journey, just the destination point right then.
So what's it actually reporting? What are the main categories we need to wrap our heads around?
Fundamentally, it boils down to 3 things. First, assets.
What the company owns.
Right. Things that have future economic benefit. Cash, buildings, inventory, that kind of stuff. Second, liabilities.
The company owes. Debts, basically.
Yep, it's obligations to others. loans, bills to suppliers, salaries owed, and third, stockholders' equity.
Okay, what's that exactly?
It represents the owner's residual claim, what's left over for the owners after all the liabilities are paid off from the assets.
The owner's slice of the pie.
Precisely. And the absolute core, the heart of the balance sheet, is that famous accounting equation. Assets must always equal liabilities plus stockholders' equity.
Ah, the balance. It has to balance.
Every single time. No exceptions. If it doesn't balance, something's wrong.
Okay, that's why it's called a balance sheet. It literally balances. Now, within these big buckets, assets, liabilities, equity, uh, I've heard the term classified balance sheet. What's that about? Is it useful?
Oh, incredibly useful. A classified balance sheet makes a really important distinction. It separates assets and liabilities into current and non-current.
Current versus non-current, short-term versus long-term.
Exactly. Current basically means stuff expected to be converted to cash, used up, or paid off within 1 year, or the company's normal operating cycle, whichever is longer.
The operating cycle.
Yeah, that's the average time it takes to turn inventory into cash. For most companies, it's less than a year, so we usually just think 1 year.
Gotcha. So current is short-term, and non-current is everything else, longer-term stuff.
That's it. And this classification is super valuable because it gives you immediate insight into the company's liquidity.
Liquidity, can they pay their short-term bills?
Right. And its solvency, can they meet their long-term obligations?
Yeah.
It helps you quickly assess financial health and risk.
Okay, so current assets, what are some typical examples? Things that are cash or will be soon.
Yep. Think immediate financial firepower. Obviously, cash and cash equivalents, money in the bank, short-term investments that are basically cash.
Makes sense.
Then you've got accounts receivable. That's money customers owe you for stuff you've already sold them on credit. You expect to collect that pretty soon.
Okay.
And inventory. The products sitting on the shelves or in the warehouse, ready to be sold. Also things like prepaid expenses. Maybe you paid for a year's worth of insurance up front. The portion covering the next year is a current asset.
Because you've already paid for that benefit.
Mm-hmm.
Okay. So then non-current assets, these are the big, long-lasting things.
Exactly. The resources meant for sustained operations, not quick cash. This includes investments like stocks or bonds the company plans to hold for a long time.
Okay.
And of course, property, plant, and equipment, often called PPE.
The physical stuff, land, buildings, machinery.
That's it. The tangible workhorses of the business. Land, buildings, equipment. And importantly, for buildings and equipment, you'll always see a line like less accumulated depreciation.
Ah, depreciation. That's accounting for wear and tear, right?
Basically, yes. It's the total cost of the asset that's been expensed over time to reflect its use. So the balance sheet shows the original cost minus this accumulated depreciation. That gives you the asset's book value.
Got it. So the value goes down over time on the books. What about things you can't touch,
Ugh.
like brand names or patents?
Those are intangible assets, very important. You might see goodwill.
Goodwill. That always sounds a bit vague.
It arises when one company buys another for more than the fair value of its identifiable net assets. That extra amount paid, that's goodwill. It represents things like reputation, customer lists, brand recognition, valuable, but intangible.
The magic stuff.
Kind of, yeah.
Yeah.
And then you have things like patents, giving legal rights to an invention, or trademarks. These also have value. Amortization.
Similar to depreciation, but for intangibles.
Yeah.
Okay, that's a lot on the asset side. Let's flip over to liabilities, what the company owes. What are the key current liabilities, the short-term debts?
Right. Obligations due within that 1-year window. A big one is the current portion of long-term debt. If a company has a 10-year loan, the slice of the principal due in the next 12 months is a current liability.
Makes sense.
Then you have accounts payable. That's money owed to suppliers for goods or services bought on credit, standard bills.
Okay.
Salaries payable, wages owed to employees. Interest payable, interest accrued on debts. An interesting one, unearned revenue.
Unearned revenue. That sounds weird. How can revenue be a liability?
Because the company received cash from a customer before delivering the goods or services. Think magazine subscription that paid up front, or airline tickets bought in advance. The company owes the customer that service or product. It's an obligation.
Ah, okay.
Yeah.
They owe a service, not money back necessarily, but it's still an obligation.
Okay.
And then long-term liabilities, beyond 1 year.
Yep. The big ones here are often things like bonds payable, where the company borrowed money from investors by issuing bonds, or long-term notes payable, like mortgages or other long-term loans. Also, things like pension liabilities or deferred income tax liabilities can show up here. These represent significant long-run commitments.
Right. And finally, that owner's slice again. Stockholders' equity, what's in there?
This is the owner's stake. Key components include capital stock, often broken down into preferred and common stock. This represents the basic investment shareholders made when buying shares.
The initial investment.
Sort of, yeah. Based on the par value, often you'll see paid-in capital in excess of par, which is the amount shareholders paid above that nominal par value. But the really big one usually is retained earnings.
Retained earnings.
Yeah.
Sounds like profits they kept.
Exactly. It's the grand total of all the net income the company has earned over its entire history, minus any dividends it paid out to shareholders. It shows how much profit has been plowed back into the business to fund growth. Super important indicator.
Oh, yeah. Tells you a lot about their history.
And then there's a line called Accumulated Other Comprehensive Income, or AOCI. This is where those OCI items we mentioned earlier collect. We'll circle back to that one later, but it's part of equity. And sometimes you see treasury stock, which is stock the company bought back from the market.
Okay, that's a fantastic breakdown. It really drives home why it's called a balance sheet owns, owes, owner's stake, all balancing out. So
Yeah.
the big takeaway for someone looking at this, what should they focus on?
Well, it's foundational. Immediately, you look at current assets versus current liabilities to gauge liquidity. Can they pay the bills coming due?
Quick checkup.
Yeah. And then you look at the overall mix. How much debt versus equity? That tells you about solvency, their long-term financial stability, and risk. How leveraged are they? It's a critical starting point for understanding a company's financial structure and health, a real snapshot of its condition. 3. Deep dive 2. The income statement. The story of a period's performance.
Okay, if the balance sheet is the snapshot, the income statement is, well, it's more dynamic, isn't it? Like that highlight reel or report card for a specific period. A quarter maybe, or a full year?
That's a great way to think about it. It's not about a single point in time, but about performance over time.
Right. It tells us how much money the company made and how much it spent during that period. Ultimately, was it profitable?
Precisely. Its purpose is to show the sources of funds, that's revenues and gains, and the uses of funds, expenses, and losses, all related to the income-earning activities during that defined time frame.
And why is this so crucial? What can you, our listener, really do with this information? What's the value?
Oh, it's incredibly useful for so many things. First, obviously determining profitability. Is the company making money? How much?
The bottom line, right?
Yeah. It's also key for valuing the company. Investors pore over earnings trends to decide if a stock is worth buying.
Makes sense.
Creditors use it to assess creditworthiness. Can the company generate enough income to pay back its loans?
Uh-huh.
And maybe most importantly, it helps in predicting future cash flows. Past performance isn't a perfect predictor, but it gives you crucial patterns and trends about the company's ability to generate cash in the future. How much, when, how certain is it?
Right. Past performance isn't a guarantee, as they always say. But it definitely gives you a baseline, some trends. That actually raises a question, though. How accurately can past performance predict the future? I mean, things change so fast these days.
That's a fair point. It's definitely not a crystal ball. But think of it this way. The income statement reveals the company's fundamental operating patterns. Are revenues growing consistently? Are costs under control? What are the profit margins?
Kind of like understanding its basic engine.
Exactly. You see the engine's performance under known conditions. Then you can start layering on your analysis about, market changes, new competition, economic shifts. But without understanding that baseline performance from the income statement, your predictions are just guesswork. It lets you ask, is the core business itself healthy and sustainable? That's step 1.
Okay, that makes sense. So before we dive into the different ways it can be structured, let's nail down some key terms. We hear cost and expense used almost interchangeably sometimes. Is there actually a difference?
There is a subtle but important difference in accounting. A cost is simply the amount you pay for something, an asset, a service, whatever. It's the expenditure.
Okay, the price tag.
Right. Now, some costs benefit only the current period, like paying this month's electricity bill. That cost immediately becomes an expense. But other costs provide benefits over future periods. Those are initially recorded as assets. We call them unexpired costs.
Unexpired costs. So they're assets first, like inventory or a machine.
Exactly. They sit on the balance sheet as assets because their benefit hasn't been used up yet. They're unexpired.
Okay, so how do they become expenses then?
They become expenses as their benefit is consumed or expires. That's when they transform into expired costs, which is just another term for expenses on the income statement. It's all about matching the cost to the period it benefits.
Ah, the matching principle. Okay, give me a couple of quick examples of that transformation. Unexpired costs becoming an expense.
Sure. Think inventory. You buy goods for $100. That $100 cost sits on the balance sheet as inventory, an asset, unexpired cost. When you sell those goods, that $100 moves to the income statement as cost of goods sold, an expense, expired costs.
Okay, match the cost to the sale.
Or you pay $1,200 for a year's worth of prepaid insurance. That $1,200 is an asset. Each month, $100 of that insurance coverage expires. So each month you record $100 of insurance expense.
Right.
Same with a fixed asset, like a machine. You buy it for $50,000 asset. Over its useful life, say 5 years, you systematically allocate its cost to depreciation expense each year. It's spreading the cost over the periods it helps generate revenue.
That's super clear now. Cost is the initial payment, unexpired cost is the asset waiting to be used, and expense is the cost recognized when the benefit is used.
Got it. Now, what about revenues and expenses versus gains and losses? I've seen things like gross concept and net concept. What's that about?
Good question. It relates to how these items are presented on the income statement. Revenues and expenses are generally reported using the gross concept.
Meaning, revenues are shown at the full amount you expect to receive for your goods or services. If you sell something for $100, revenue is $100. Expenses, similarly, are the full costs incurred that benefit the current period or the allocation of those unexpired costs. They're shown at their full gross amounts.
So you see the full scale of the main business activities.
Exactly. Now, gains and losses are usually reported using the net concept.
Net. So proceeds minus cost.
Pretty much. A gain often arises from activities outside the company's ordinary course of business. For example, selling an old piece of equipment for more than its book value. Or maybe finding gold on company property, unlikely but possible.
Uh-huh. Wouldn't that be nice?
It's reported net, so the proceeds, $15,000 minus the book value, $10,000, equals a $5,000 gain.
Okay. And losses are the flip side.
Yes. A loss is also typically from peripheral activities, not the main business. Maybe selling an investment for less than you paid or abandoning some useless equipment. Again, reported net. The key difference is these aren't part of your core day-to-day selling of goods or services.
Got it. And what if something is unusual or happens rarely, like a big restructuring cost?
Great point. If an income or loss item is either unusual in nature or happens infrequently or both, it should be reported separately with an income from continuing operations. You don't just bury it, you highlight it and disclose its nature so users understand it's not part of the normal run of business. Transparency is key.
Right. Helps people see what's recurring versus what's a one-off. Okay, so we have the building blocks. Now, how do accountants put this all together? I know there are a couple of main formats for the income statement. Let's start with the multiple-step income statement. Sounds detailed. 3.1, multiple-step income statement.
It is. The multiple-step income statement is designed to provide more detail by separating operating activities from non-operating activities.
Operating meaning the main business.
Exactly. Your core business functions. It separates operating revenues and expenses from non-operating stuff like interest income or gains on investments, and also from other gains and losses.
And why do that? What's the benefit?
The big benefit is it gives users much clearer insights. You can easily calculate key performance ratios like gross profit margin or operating profit margin right from the statement. It gives you a segmented view of profitability. How well is the core business doing versus other activities?
Okay, that sounds really useful. Let's walk through an example from our source, Radon Industries, Inc. How does this multiple-step structure start?
It typically starts right at the top with net sales. This is total sales revenue from goods, services, rentals, whatever they do, minus any sales returns, allowances, or discounts. For Radon, this came out to $650,000.
Okay, $650K in net sales. What's next?
Next, you subtract the cost of sales, sometimes called cost of goods sold, or COGS. These are the direct costs tied to generating those sales, the cost of the inventory sold, the direct cost of providing the service, etc. For Radon, these costs totaled $410,000.
So $650,000 net sales minus $410,000 cost of sales. That gives us $240,000. What's that called?
That crucial number is the gross margin or gross profit, $240,000 for Radon.
Gross margin. So that's the profit just from selling their stuff before considering things like salaries, rent, advertising. That seems really important.
Critically important. It tells you how profitable their core product or service is on its own, how much is left over after the direct costs of producing or acquiring it. It's a key measure of production or pricing efficiency.
Okay, $240 of gross margin. What comes after that?
Next, we subtract the operating expenses. These are the costs of running the business day to day, not directly tied to making the product, but necessary for operations.
Like salaries, rent, utilities, marketing.
Exactly. They're often broken down into categories. Common ones are selling expenses, think advertising, sales commissions, shipping costs out to customers, and general and administrative G&A expenses like office staff salaries, rent for the headquarters, insurance, accounting fees. Depreciation expense is also typically included here as an operating expense. For Radon, all these operating expenses added up to $250,000.
Okay, wait. Radon had a gross margin of $240,000,
Right.
but their operating expenses were $250,000.
That's right.
So if we subtract the 250K from the 240K, they have a negative $10,000. What's that line item called?
That line is income, or in this case, loss, from operations. And yes, for Radon, it's a $10,000 loss from operations.
Wow. Okay, that seems like a massive red flag, doesn't it? Their core business isn't even covering its own operating costs.
Absolutely. That operating income or loss figure is arguably one of the most important numbers on the income statement. It tells you if the fundamental business model is profitable before you even factor in financing costs like interest or taxes or any unusual items. A loss here is definitely a cause for concern.
Yeah, you'd want to understand why that's happening. So their core operations lost $10,000. What comes after that? Does the story end there?
Not necessarily. After operating income, we account for other revenues and gains. These are income sources outside the main business activities.
Like what?
Could be interest earned on bank accounts, dividends received from investments, gains from selling off assets that aren't part of the core operation, like maybe selling some unused land. For Radon, they had things like interest revenue and a gain on selling some securities, totaling $350,000.
Okay, so some positive news there.
Yeah.
And then I assume there's other expenses and losses.
You got it. These are expenses not related to the core operations. Common examples are interest expense paid on debt, losses from selling investments, or maybe restructuring costs if the company is undergoing a major overhaul. Radon had $190,000 in this category, including interest expense and a loss on selling some fixed assets.
Okay, let's put it together. They started with a $10,000 loss from operations. Then they added $350,000 in other revenues gains and subtracted $190,000 in other expenses losses. So minus 10 plus 350 minus 190. That gets us to positive $150,000. What's that line?
That's income before income tax, $150,000 for Radon.
Almost there. Just need to account for taxes now.
Right. Subtract the income tax expense. For Radon, that was $100,000.
So $150,000 minus $100,000 gives $50,000. Is that the final number?
That gives us income from continuing operations, $50,000. This is the profit from the parts of the business that are, well, expected to continue.
Continuing operations. Okay, but I see one more section on the Radon example. Discontinued operations, net of tax, showing a loss of $25,000.
Yes. We'll dive deep into that specific topic next. But basically, if a company sells off or shuts down a major part of its business, the profit or loss from that part is shown separately here, after tax.
To keep it separate from the ongoing business results.
Exactly. So for Radon, you take the $50,000 income from continuing operations, subtract the $25,000 loss from discontinued operations.
And you finally arrive at the net income, $25,000 for Radon, the famous bottom line.
That's the one.
Phew. That multiple-step statement certainly provides a lot of detail and useful subtotals along the way. Now, for comparison, let's look at the single-step income statement. This sounds easier. 3.2, single-step income statement.
It is definitely simpler in its presentation. The single-step income statement basically does just what the name implies.
One step.
Yep. It groups all revenues and gains together in one section, regardless of whether they're operating or non-operating. Then, it groups all expenses and losses together in another section.
Okay, just two big lists.
Right. And then in one single calculation, you subtract the total expenses and losses from the total revenues and gains to get income from continuing operations.
No subtotals like gross margin or operating income.
Nope. It jumps right to income from continuing operations.
So if we took our Radon Industries example again, how would it look single-step style?
You'd have a revenues and gains section listing net sales, $650K, service revenue, interest revenue, rental revenue, the gain on sale of securities, and other revenue. Add all those up, and for Radon, the total comes to $1 million.
Okay. Total income sources.
Yep.
$1 million.
Then you'd have an expenses and losses section. This would include cost of goods sold, cost of services, cost of rentals, selling expenses, G&A expenses, interest expense, depreciation, the loss on sale of fixed assets, the restructuring expense, and income tax expense. Add all of those up for Radon, and the total is $950,000.
Okay. Total expenses and losses. $950,000.
Now for the single step. Total revenues, $1 million minus total expenses, $950,000 equals
$50,000, which is the same income from continuing operations we got with the multiple step method.
exactly the same. And then, just like before, you'd show the discontinued operations loss of $25,000 separately below that.
Leading to the same final net income of $25,000. Okay, so the bottom line is identical. It's purely about the presentation along the way. Why would a company choose this simpler format over the detailed multiple step?
That's actually a fascinating point. The choice really reflects how a company wants to tell its financial story.
How so?
Well, the multiple step format, as we saw, offers those granular insights. It highlights operational efficiency with things like gross margin and operating income, great for analysts who want to dig deep.
Right, lots of detail.
The single step format, on the other hand, prioritizes simplicity and clarity. It avoids any implied hierarchy or importance among different types of revenues or expenses. Everything just gets lumped together.
Maybe easier for a general audience to quickly grasp the overall result.
Possibly, yeah. Some argue it's less potentially misleading because it doesn't emphasize certain subtotals over others. So it's a trade-off. Detail and analytical power versus simplicity and conciseness. The company chooses which story it wants to emphasize. 4. Spotlight on. Income from discontinued operations when a part of the business leaves.
Okay, this next part, you mentioned it briefly, but it sounds really interesting and honestly pretty important for understanding a company's future. What happens when a company sells off or decides to sell off a major part of its business?
Yeah, this is discontinued operations.
It's not just treated like a regular gain or loss on selling an asset, is it? It gets its own special section on the income statement, right below income from continuing operations. And it's always shown net of tax. Why this special treatment?
It's all about clarity and predictive value for the users of the financial statements, investors, analysts, lenders, you.
How so?
Think about it. If a company gets rid of a whole division, that division's revenues and expenses won't be there next year. If you just lumped its results in with everything else, it would distort the picture of the ongoing business.
Right. It makes it harder to figure out what the company will look like going forward.
Exactly. By separating out the results of the part that's leaving, you get a much cleaner view of the continuing operations, the part of the business that will be driving future results. It allows for better forecasting and analysis of the sustainable core business. That's why it's so crucial.
Okay, makes sense. It's about isolating the noise from the part that's gone. So what actually qualifies as a discontinued operation? Can a company just sell off an old warehouse and call it that?
No, it has to be significant. It applies to the disposal of a component of an entity or a group of components. This could be a whole subsidiary, a division, an asset group, or even a nonprofit activity.
Good component.
Yes. And the key condition, this is critical, is that the disposal must represent a strategic shift that has or will have a major effect on the company's operations and financial results.
A strategic shift. That sounds important. What does that actually mean? It can't just be routine asset sales.
Definitely not. Think big picture changes. Examples might include disposing of a major geographical area, like a U.S. company selling off all its European operations.
Okay. Right.
Or disposing of a major equity method investment, selling off a large chunk of ownership in another significant company. Or, probably most common, disposing of a major line of business, like a company getting out of electronics manufacturing to focus purely on software. It's a fundamental change in direction.
Okay, so it has to really alter the company's footprint or focus. The source material gives a good example with AmServe Inc., the food service company. Can you walk us through that?
Sure. AmServe delivers frozen food. They sell to fast food places, high-end restaurants, diet food companies, institutions, a mix. Historically, their biggest segment, both revenue and profit-wise, was the fast food division.
Okay, the core of their business.
Right. But management forecasts show that segment declining as people want healthier food. So they decide to sell the fast food division. Their new strategy is to focus on selling healthier options to smaller, local restaurants, expecting lower revenue per unit but higher profit margins.
So why does that move qualify as a major strategic shift requiring discontinued operations reporting?
Because the fast food division was their largest component by far. Selling it fundamentally changes AmServe's business model, its operational focus, and its future financial profile. It's a clear strategic pivot away from volume fast food towards higher margin health food. Therefore, its results need to be pulled out and reported separately so investors can see the new AmServe clearly.
Makes perfect sense. It's a real redirection.
Hmm.
Okay, now let's get into the nitty-gritty. When a company has a discontinued operation, what specific financial results get included in that separate section on the income statement?
Good question. There are essentially three main things you'll see bundled into that line item, all reported net of tax.
Okay, number one.
First, the results of operations of the component itself for the period reported. So the revenues and expenses generated by that division before it was sold or classified for sale.
Its own mini income statement results, basically.
Pretty much, yeah. For the time it was still part of the company during that reporting period. Second, any gain or loss on the actual disposal of the component. This is recognized when it's finally sold.
The profit or loss from the sale transaction itself.
Right. And third, potentially an impairment loss.
Yeah.
This happens if, when the company decides to sell, classifies it as held for sale, the component's carrying value on the balance sheet, its book value, is higher than its fair value minus the estimated costs to sell it.
So if it's worth less than what the books say, they have to recognize that loss immediately.
Yes, you recognize the impairment loss in the period it's classified as held for sale. There's a nuance, though. If the fair value later increases, you can recognize a gain, but only up to the amount of the loss you previously recognized. You can't book a gain beyond the original carrying amount.
Okay, prevents artificially inflating gains. And when do these items actually show up on the income statement, just in the year the sale happens?
No, it's broader. The results of the discontinued operation are reported in the period it's either disposed of or classified as held for sale. And crucially, this reporting applies not just to the current period's income statement, but also to the income statements of any prior periods presented alongside it for comparison.
Ah, so they restate past income statements too.
Yes, they recast them to show the discontinued operations separately for those prior years as well. This gives you a consistent, comparable view of the continuing operations across all years shown. It makes trend analysis much more meaningful.
That's smart. And you mentioned classified as held for sale. Is there anything special that happens once something gets that label?
Yes, a key detail. Once a component is classified as held for sale, the assets within that component, building, equipment, intangibles, are no longer depreciated or amortized.
Why not?
Because the thinking is, those assets are no longer being used to generate revenue for the ongoing business. Their value is now based on their expected selling price, not their operational use. So you stop spreading their cost via depreciation amortization.
Okay, that makes sense. And how is this held for sale component valued on the balance sheet while waiting to be sold?
It's measured at the lower of its current carrying amount, book value, or its fair value less cost to sell.
Fair value less cost to sell, meaning what they expect to get for it, minus broker fees, legal costs, etc.
Exactly. The net amount they realistically expect to pocket from the sale. So it gets marked down immediately if the expected net proceeds are less than the book value.
Got it. This seems complex. Let's try and solidify it with the All Sports Company example in their golf division. This covers both the held for sale year and the actual sale year.
Right. This is a good one. So All Sports Company decides on April 30th of year one to sell its golf division. On that date, the division's assets have a carrying value, book value, of $4 million. But they estimate its fair value less costs to sell is only $2.2 million. Ouch.
Definite impairment there.
Yep. The division isn't actually sold until June 30th of year two. And let's assume All Sports has a 40% tax rate.
Okay, so let's look at year one. It's not sold yet, but it's classified as held for sale as of April 30th. How does this show up on the year one income statement?
Two things related to the golf division will appear in the discontinued operations section, net of tax. First, the loss from the golf division's operations from January 1st to April 30th, the date it was classified. Let's say the trial balance shows it lost $2.4 million pre-tax during those 4 months.
Okay, a $2.4 million operating loss for the division.
We need to report that net of tax. So $2.4 million loss times 1.40 tax rate, which is 0.60. That gives a $1,440,000 loss from operations of discontinued component, net of tax.
Okay, that's the loss from just running the division before deciding to sell. What else for year one?
The impairment loss. We said carrying value was $4 million, but fair value less cost to sell was $2.2 million. That's an impairment loss of $1.8 million. 4 meter, 2.2 meters.
And that also needs to be net of tax.
Correct. $1.8 million loss times 0.60 equals a $1,080,000 impairment loss on discontinued component, net of tax.
So on the year one income statement, below income from continuing operations, you'd see these two lines. Loss from operations, $1,440,000, and impairment loss, $1,080,000, clearly labeled as discontinued operations.
Exactly. Totaling a $2,520,000 loss from discontinued ops for year one. It clearly separates the impact of the exiting business.
Okay, now let's move to year two. The golf division is finally sold on June 30th. What shows up in discontinued operations for year two?
Again, we need to report the results. First, the loss from the golf division's operations from January 1st of year two up until the sale date, June 30th. Let's say it lost another $1.2 million pre-tax during those 6 months.
Okay, so net of tax. 1.2 million times 0.60 is a $720,000 loss from operations of discontinued component, net of tax.
Right. And then we need the gain or loss on the actual disposal. Let's say they actually sold it for $2 million. Remember, at the end of year one, it was valued on the books at its fair value less cost to sell, which was $2.2 million.
So they sold it for $200,000 less than its adjusted book value.
Looks like it. So that's a $200,000 loss on disposal, $2 2-meter book value, $2 per proceeds. Net of tax, $200,000 times 0.60 is a $120,000 loss on disposal of discontinued component, net of tax.
Okay, so for year two, the discontinued operations section would show the $720,000 loss from operations before sale and the $120,000 loss on the sale itself, both net of tax.
Precisely, adding up to a total loss from discontinued ops of $840,000 for year two.
Wow, that's detailed, but it makes so much sense why they do it. This meticulous separation really lets you analyze the core, ongoing business performance without all the noise and distraction from a major piece that's being jettisoned. It gives you a much clearer view of the company's future earning power.
That's the entire goal: transparency and predictive value. 5. Understanding global money. Foreign currency transactions.
All right, let's switch gears a bit. In today's world, businesses are global. Companies are constantly buying from, selling to, and operating in other countries. That means dealing with different currencies. So what happens when, say, a U.S. company buys parts from a supplier in Germany and agrees to pay in euros? It's not just a simple conversion, is it?
No, it introduces a layer of complexity, specifically foreign currency transaction gains and losses.
Why do those happen?
They happen precisely because the company agrees to settle the transaction pay or receive cash in a currency other than its own functional currency, which for a U.S. company is usually the U.S. dollar. The issue is that the exchange rate between the two currencies can change between the time the deal is made and the time the cash actually changes hands.
Ah, the fluctuating exchange rates.
Yeah.
That raises a key question, though. Why does the rate fluctuation matter so much? I mean, don't they just convert the money when they actually pay the bill?
Well, yes, they convert when they pay. But accounting requires you to record the transaction, the purchase and the liability on the date it happens, using the exchange rate on that day.
Okay, so you book it at day one's rate.
Right. But if the exchange rate changes by the time you pay, say, 60 days later, the amount of U.S. dollars you actually need to pay will be different from the liability amount you initially recorded in U.S. dollars. That difference creates a gain or a loss.
It's like the value of your debt changes in your own currency even before you pay it.
Exactly. It's the risk you take when you agree to transact in a foreign currency. The value shifts.
Okay, let's get some terms straight. What exactly is an exchange rate? We hear about it all the time.
Simply put, it's the price of one currency expressed in terms of another. How many units of currency B does it take to buy 1 unit of currency A?
And there are different ways to state it.
Yeah, 2 main ways. The direct method shows the domestic price for 1 unit of the foreign currency. For the U.S., that would be like saying $1.10 per euro.
Okay, how many dollars for 1 euro?
Right. The indirect method is the opposite. The foreign price for 1 unit of the domestic currency, like 0.91 euros per $1. Most major currency quotes you see are direct quotes from a U.S. perspective.
Gotcha. And the current exchange rate or spot rate?
That's just the rate right now for immediate exchange and delivery of the currency.
Okay. And when we say a transaction is denominated in euros?
That just means euros is the currency specified in the contract for settlement. That's the currency the final payment must be made in.
Okay, so the aha moment here is that a gain or loss pops up if the spot rate changes between the transaction date and the settlement date. That's the core issue.
Huh.
But what if the transaction isn't settled by the end of the accounting period? Like you buy something in December but don't pay until February.
Excellent question. That's where unrealized gains and losses come in. If you have an outstanding accounts payable or receivable denominated in a foreign currency at the balance sheet date, say December 31st, you have to remeasure it using the spot rate on that balance sheet date.
Remeasure it, even though you haven't paid or received cash yet.
Yes. You compare the US dollar equivalent using the December 31st rate to the US dollar amount you originally recorded or last adjusted. The difference is an unrealized gain or loss, and importantly, it gets recognized in current net income for that period.
Wow, so currency fluctuations can hit your income statement even before the transaction settles.
Absolutely. It reflects the economic reality of the change in the value of that receivable or payable. Accrual accounting requires recognizing those changes as they happen.
Okay, and just to recap, how was the initial transaction recorded? What rate do you use then?
You always record the initial asset, liability, revenue, or expense using the exchange rate in effect on the date of the transaction. That
Yeah.
sets the starting point.
Okay, let's make this concrete with example 4. Alinto Company, it's a U.S. company. On December 1, year 1, they bought goods on credit from a supplier in Mexico for 100,000 pesos. They agreed to pay in pesos. They actually paid on February 1st, year 2.
Got it.
Now, the exchange rates were December 1, year 1 purchase date, 0.10 cents per peso. December 31, year 1, balance sheet date, $0.08 per peso. Feb 1, year 2, payment date, $0.09 per peso. Feb 1, year 2, payment date. How does Alinto account for this? Let's start with the purchase on December 1st.
Okay, on December 1, year 1, Alinto records the purchase and the corresponding accounts payable. They owe 100,000 pesos. The rate is $0.10 peso. So they record the inventory asset and the accounts payable liability at 10,000 US dollars, 100,000 pesos, 0 cents.
Right, $10,000 liability booked initially. Now, fast forward to December 31st, year 1. It's the balance sheet date, the bill hasn't been paid, and the rate has dropped to $0.08 per peso. What happens?
Alinto needs to remeasure that 100,000 peso liability using the current spot rate. At 0.08 cents per peso, the liability is now only worth 8,000 US dollars, 100,000, 8 cents per.
But they booked it at $10,000.
Exactly. The liability has decreased in US dollar terms by $2,000, $10,000, $8,000. Because it now takes fewer dollars to pay off the peso debt, this is good news for Alinto. They recognize a $2,000 unrealized foreign exchange transaction gain in their year 1 net income.
Again, even though they haven't paid.
Right.
Because their debt effectively shrunk in dollar terms.
That's fascinating. Okay, so going into year 2, the liability is sitting on their books at $8,000. Now it's February 1st, year 2, payment day. The rate has ticked back up to 0.09 cents per peso. What happens when they pay?
On Feb 1st, Alinto has to buy 100,000 pesos to pay the supplier. At 0.09 per peso, that will actually cost them 9,000 US dollars in cash. 100,000. Is that are those
Yeah.
nines? Okay, they paid $9,000 cash. But the liability on their books from December 31st was only $8,000.
Correct. They paid $9,000 to settle a liability recorded at $8,000. That means they experienced a $1,000 foreign exchange transaction loss, $9,000 cash, paid $8,000 liability removed. This $1,000 loss is recognized in Alinto's year 2 net income.
Wow. So they had a gain in year 1 when the rate dropped and a loss in year 2 when it went back up a bit before payment. It really shows how these exchange rate movements create volatility in reported earnings.
Absolutely. It's a constant risk for companies involved in international trade. Managing this foreign exchange risk is a big deal for their financial performance. For anyone listening, understanding this helps you see how global economics can directly impact a company's bottom line, sometimes significantly. 6. The grand finale. Statement of comprehensive income, the full picture of equity change.
Okay, we've covered the snapshot of the balance sheet. We've covered the period's performance story, the income statement. But you mentioned there's one more layer, something that gives the full picture of how a company's equity changes beyond just net income. That's the statement of comprehensive income, right?
That's the one. It pulls everything together, 6.1 definitions.
So let's start with the basics. What exactly is comprehensive income?
Comprehensive income is defined as the total change in a company's equity, its net assets, during a period that comes from non-owner sources.
Non-owner sources. What does that mean?
It means it includes all changes in equity except for transactions with the owners themselves, like issuing stock, investment by owners, or paying dividends, distribution to owners. Everything else that affects equity is part of comprehensive income.
Okay, so it's broader than just net income.
Yes. The formula is basically comprehensive income, net income, plus other comprehensive income, OCI.
Okay, so net income is what we get from the income statement profit from continuing and discontinued operations. We've covered that. But then there's this other comprehensive income, OCI. This sounds like that hidden layer you mentioned. What is this stuff, and why isn't it just included in net income in the first place?
This concept can be a bit tricky, but it's vital. OCI includes specific types of revenues, expenses, gains, and losses that, under U.S. GAAP, are explicitly excluded from net income but are included in comprehensive income.
Excluded from net income.
Why?
Generally, it's because these items haven't been fully realized yet in the traditional sense, or they relate to activities whose effects are considered potentially volatile or long-term, and including them in net income right away might distort the picture of the company's core operating performance for the period.
So they affect the company's overall value or equity, but they're kept separate from the regular profit calculation for clarity. That's a good way to put it. OCI recognizes changes in asset and liability values that impact the company's financial position, but haven't necessarily resulted in cash changing hands or haven't met the criteria for recognition in net income yet. It gives a broader view of economic performance.
Okay, I think I'm getting it.
Yeah.
Can you give us some specific examples of things that fall into this OCI category? What kind of items are we talking about?
Sure, a classic example involves unrealized gains and losses on available-for-sale debt securities.
Available for sale, meaning they might sell them, but they aren't actively trading them day to day.
Exactly. These are debt investments, maybe bonds. Their market value goes up and down. Those changes in fair value are recorded in OCI, not net income, until the company actually sells the security. At that point, the realized gain or loss moves out of OCI and into net income.
So it's like tracking paper gains or losses that haven't been locked in yet.
Precisely. Another big area is related to certain pension adjustments. Accounting for defined benefit pension plans is complex, and certain actuarial gains or losses or adjustments from plan changes often go through OCI, though the specifics here can get very technical.
Okay, pensions,
Yeah.
complex, got it. What else?
Gains and losses on certain derivative instruments that are designated as cash flow hedges. Companies use derivatives to manage risks like future interest rate changes or commodity price changes. If a derivative qualifies as a cash flow hedge, its gains or losses are parked in OCI until the hedge transaction actually affects earnings. This prevents hedge volatility from whipsawing net income before the underlying risk hits.
Okay, hedging effects, kept separate until relevant. Makes sense. What about foreign currency stuff? We saw transaction gains losses hit net income. Does anything go into OCI?
Yes, but a different aspect. Foreign currency translation adjustments go into OCR. This happens when a U.S. parent company consolidates the financial statements of its foreign subsidiaries that operate in a different functional currency, like euros or yen.
Consolidating, like combining their results.
Right. When you translate the foreign subsidiary's balance sheet and income statement into U.S. dollars for the consolidated report, changes in exchange rates create translation adjustments. These reflect the change in the U.S. dollar value of the subsidiary's net assets purely due to currency movements. These adjustments sit in OCI.
So it's about the overall value change of the foreign operation due to currency rates, not specific transactions.
Correct. Also, gains or losses on foreign currency transactions that are designated as hedges of a net investment in a foreign entity also go to OCI. These OCI items related to foreign currency usually stay there until the company sells or substantially liquidates its investment in that foreign operation.
Keeps that potentially large currency impact separate until the investment itself is dealt with.
Exactly. And one more recent addition, instrument-specific credit risk. If a company chooses to measure certain liabilities at fair value, any change in that fair value that's due to changes in the company's own credit risk goes to OCI, not net income.
Why that separation?
Because it prevents the weird situation where a company could report higher net income simply because its own creditworthiness got worse, making its debt less valuable and thus creating a gain. That doesn't make economic sense, so that portion of the value change goes to OCI.
Yeah, you shouldn't profit from your own increasing risk.
Yeah.
Okay, that makes sense. So these items go into OCI first. Do they stay there forever, or do they eventually hit net income?
Most of them eventually do hit net income through what are called reclassification adjustments.
Reclassification, moving them out.
Exactly. When the condition that kept an item in OCI is met, for example, when the available-for-sale security is sold or the hedged cash flow affects earnings, the accumulated gain or loss related to that item is moved from OCI to net income in that period.
So the unrealized gain becomes a realized gain in net income.
Right. This reclassification ensures the gain or loss isn't counted twice in comprehensive income over different periods. Once as OCI, once as net income. It clears it out of OCI when it finally belongs in net income.
Okay, that's important for avoiding double counting.
Yeah.
Now, where does all this OCI accumulate? Does it just vanish after being reported?
No, it doesn't vanish. It accumulates on the balance sheet in a separate component of stockholders' equity called Accumulated Other Comprehensive Income, AOCI.
AOCI. Like retained earnings is accumulated net income, AOCI is accumulated OCI.
Perfect analogy. AOCI is the running total, the sum of all OCI items from the current period and all prior periods, net of any reclassification adjustments. It sits right there in the equity section of the balance sheet.
Got it. So here's a key takeaway then. At the end of the year, net income gets closed out to retained earnings, right?
Correct.
And other comprehensive income gets closed out to accumulated other comprehensive income.
Exactly right. Both net income and OCI, which together make up comprehensive income, ultimately find their home on the balance sheet, increasing or decreasing total equity. It all ties together. 6.2 financial statement reporting, 2 ways to present.
Okay, so we understand what comprehensive income and OCI are. How do companies actually show this information? Does it get its own dedicated statement?
It has to be presented prominently, just like the other main financial statements. U.S. GAAP allows 2 main approaches for displaying comprehensive income.
2 ways. What's the first option?
The first is the single statement approach. This presents comprehensive income as one continuous statement that includes both net income and other comprehensive income.
So it flows right from revenues and expenses down through net income and then keeps going to show the OCI items and the final comprehensive income total.
Exactly. It displays the OCI components individually and in total directly below the net income line, all within a single statement of comprehensive income.
Okay, let's use the Sydney Technologies, Inc. example to see that. They had revenues of $20 million, expenses of $18.4 million, leading to income before tax, then income tax, and finally a net income of $1.2 million. How would OCI appear on this single statement?
Right after that $1.2 million net income line, you'd see a section titled Other Comprehensive Income. Within that, Sydney would list its specific OCI items. For instance, they had unrealized holding gains on available-for-sale securities net of tax of $210,000.
Okay, a positive OCI item.
And they also had foreign currency translation loss net of tax of $52,500.
A negative OCI item.
Right. So you'd add the $210,000 gain and subtract the $52,500 loss. That gives a total other comprehensive income for the period of $157,500.
Okay, total OCI is $157,500.
Then the final step on the single statement is to add that total OCI to the net income. So $1.2 million net income plus $157,500. Other comprehensive income equals a total comprehensive income of $1,357,500. It's all laid out in one continuous flow.
Got it. One statement showing the whole journey from revenues to comprehensive income. What's the second option?
The second is the two-statement approach. This is also quite common.
Two-statement.
Meaning, you present a traditional income statement first, ending with net income. Then immediately following that, you present a separate statement of comprehensive income. This second statement starts with the net income figure from the first statement and then lists the OCI components to arrive at the total comprehensive income.
So you have the regular income statement and then a second, shorter statement that basically bridges net income to comprehensive income by adding the OCI items.
Exactly. The end result, the total comprehensive income number, is identical in both approaches. It's purely a choice of presentation format. Combine it all into one statement or show it in 2 closely linked statements.
Seems like a stylistic choice, but the core information is the same either way. 6.3, other reporting issues, transparency matters.
Yes, and regardless of the format, transparency is key. For instance, the tax effects of OCI need to be clear.
How so?
Companies can report each OCI component net of its specific tax effect. Like we saw in the Sydney example, $210,000 was already after tax. Or they can show the OCI components before tax and then show a single aggregate income tax expense or benefit related to all the OCI items together. Either way, the tax impact must be disclosed either on the face of the statement or in the footnotes.
Okay, makes sense. Need to see the tax piece. What about interim reports like quarterly statements? Does comprehensive income show up there too?
Yes, it does. A total for comprehensive income must be reported in the condensed interim financial statements that companies issue to shareholders. It's not just an annual thing. Investors get regular updates on these broader equity changes throughout the year.
Good. Consistency matters. And are there any other specific disclosures that are always required no matter which presentation format they use? Things we should always look for.
Absolutely. To ensure full transparency, companies always need to disclose
1.
the tax effects allocated to each component of OCI. We just covered that, but it's crucial. The changes in the accumulated balances of each component of AOCI, accumulated other comprehensive income, on the balance sheet. So how did the balance of unrealized gains change? How did the foreign currency translation balance change? This reconciliation can be shown right on the balance sheet, in the statement of stockholders' equity, or in the notes. It shows the flow in and out of AOCR.
So you see the beginning balance, what was added, current OCI, what was removed, reclassifications,
Yeah.
and the ending balance for each type of AOCI.
Exactly. Third, the total AOCI balance must always be shown as a distinct component of equity on the balance sheet itself.
Got it. And fourth?
Those reclassification adjustments we talked about, the amounts moved from OCI to net income during the period, these must be disclosed. This is critical to avoid double counting. Companies have to show these reclassification amounts separately from the new OCI arising in the current period.
So you can clearly see what's flowing out of AOCI into net income versus what's flowing into AOCI this period.
Precisely. Any significant items reclassified out of AOCI have to be disclosed, usually in the notes, explaining what they relate to. Again, it's all about giving users the information they need to understand the full story of equity changes.
That's a lot of detail, but I can see why it's all necessary. It really aims to make the whole picture, including those sometimes weird OCI items, as clear and understandable as possible.
That's the goal. If we connect this back to the big picture, the statement of comprehensive income ensures that users see the full economic impact of certain events on a company's equity, even if those impacts don't hit the traditional net income bottom line right away. It reveals a much broader picture of financial health, stability, and risk, which is absolutely crucial for making truly informed valuations and investment decisions. You really do need to look beyond just net income to get that complete view. Outro.
Wow. Okay. We have covered a ton of ground today,
Yeah.
seriously, from the balance sheet static snapshot,
A financial selfie.
right, through the dynamic story of the income statement,
The highlight reel.
the important nuances of discontinued operations, the complexities of foreign currency,
Don't forget those exchange rate swings.
all the way to this expansive, truly full picture we get from comprehensive income, including that mysterious OCI. We really did unpack the numbers today.
We did. And hopefully you, listening, now feel equipped with a much deeper understanding of how companies use these statements to communicate their financial health.
It's like learning a new language, almost.
It is, in a way. And now you can not just read the numbers, but hopefully start to understand the actual story behind them. How assets connect to liabilities, how revenues turn into profits or losses, and how even things like currency rates or big strategic shifts get reported. It's a powerful lens.
So let's bring it back to you, our listener. What does this all mean for you? Now that you can better identify assets, liabilities, retained earnings, operating income, OCI, how might this change the way you read a news headline about company earnings?
Or maybe how you evaluate a potential investment.
Exactly. Or even just thinking about financial concepts in your own life. Budgeting, tracking your own equity. It's a skill set that really does transcend the boardroom, doesn't it?
It absolutely does. Financial literacy is empowering in so many ways.
We really encourage you to keep exploring, keep asking questions. Don't be intimidated by the jargon. Continue your own deep dive into the world of finance. The numbers are telling a story.
And now you have a much better idea of how to interpret that language.
Thanks so much for joining us for this deep dive.
Yeah, thanks for tuning in.
Until next time, keep learning.